So they still have to go by this because that one wonderful thing we have to look at is performance obligation. All right, you've got to memorize these 5, basically. Performance obligation. So, if you have contracts, you have to identify them, and you know what a contract is, but you know it's never that easy. You know, a contract has to have enforceable rights, there has to be 2 parties, there has to be consideration, offer, acceptance, and legal tender, and all that good stuff. But there has to be enforceable rights. And you don't have to do anything, basically, unless one of the 2 sides does something. When you send out a purchase order to buy some inventory, that's sort of a contract, but you don't record debits and credits at that time, do you? You only record debits and credits when you match up your invoice from your supplier, your purchase order, and your receiving report, and then you credit accounts payable, debit inventory, whatever it was you purchased. Everybody remember that? Hopefully that's in there. But as far as contracts go, we have to look at which contracts we have. We have to identify the performance obligations in there. And we went through the idea of, okay, there's all this stuff in here. I'm selling them a piece of equipment. I got to install it. I've got to run it. I've got to maintain it. So are all those interdependent on each other? Or can we break them apart and say, oh, those are 4 different performance obligations, right? And if there are 4 different performance obligations, then we have to assign the price of the contract to each one of them. And then when we satisfy that performance obligation, we recognize the revenue. It sounds easy, but you know that we can make things a lot harder than they are sometimes. Professors have a knack for that, right? It's harder than it is. Well, that's not our goal. I promise you, that's not my goal. I want to make it easy for you, but it's not easy. It's just not. So any questions on kind of the overriding aspect? And the reason this is so important, like everything else in intermediate accounting, if this is a timeline and you've got a year end in here, and you got to remember this, if you've got a year end in here, we've got to see which performance obligations in a particular contract need to be recorded in 2015 and which ones need to be deferred to 2016. That's the main thing. Because if the whole thing is, if your contract is totally done by the end of the year, it's not really a problem. You book all your revenue over here. But if maybe some performance obligations have been satisfied, some haven't, then we have to break out how much revenue to record in 15 and how much to defer to next year. Also, you know that sometimes we'll say, oh, they're going to prepare financial statements on March 31st and June 31st. Same thing. Those are just quarterly statements, right? And so if you were going to prepare quarterly statements, you know, you'd have to worry about the performance obligations in each quarter. But it's the same concept, isn't it? You got to worry about 3 months instead of the whole year. So that's why this is so important. Again, because we have our time, we have our annual return. I'm talking about taxes. We have our annual report to worry about in that fiscal year to deal with. So that's kind of the stage, and it's never that easy. But let me get you to turn to page, and we're just going to go through as many of these as we can. Hopefully some light bulbs will come on. Page 1094. And some of these will look very familiar. There's really no difference from what you've already learned. And that's because the performance obligation has been met, has been satisfied. And there's just one performance obligation. Anytime if you go to the bookstore and buy a book, you give them your money and they give you the book. Well, their performance obligation is done, right? And you've got control of the book. Control is a big word in this FASB. You have control of the book. The person you bought it from no longer has control of the book. You have it. And you have title of that book. And I know that's common sense. Jupiter Company sells goods to Danone on account. On account, you know, they charge on January 1st, 2014. The goods have a sales price of $610. It costs them $500,000. Net 30, pays within 5 days. They get a discount of $10,000. Now, Past history indicates that cash discount will be taken. All right, so you can see what we're going to do here. We're going to book the revenue basically after the discount. Okay? So this is what we used to call the net method, and it really still is sort of the net method. But if your history indicates with this customer that they will pay, then why bother to recognize the gross and have to record the cash discount? Okay? Why bother? So you're just going to debit accounts receivable and credit sales revenue for the amount less the discount because history says they take it. You know how to make this entry. You take it out of inventory and go to cost of goods sold when that's given to you using the perpetual method. And then basically when they give you the money here, they didn't pay within the discount period, did they? They did not pay within the discount period, but you thought they were. Okay? They do not make payment until January 31st. So they didn't take advantage of the discount. You go, oh, well, that's kind of nice, really, because you just made another $10,000. So it's really kind of a finance charge, even though they didn't label it that way. If it's received after 5 days, we're just going to debit cash $600 and credit accounts receivable $600, right? So our performance obligation was met when we sold them the book, or whatever we sold them. Goods, or just as goods. It could be books, whatever. But the performance obligation was met. That's a real quick one. Any questions on that? Number 2, presented below are 3 revenue recognition. Group O sells goods to MTN for $1 million, payment due delivered. Well, you can see it's just $1 million. I mean, that's just kind of too easy. Well, so surely it's not that easy, but it is. I mean, they set it up that way. At delivery, so that's when the performance obligation happens. So start thinking about performance obligation. Go to bed thinking about performance obligation. That's when it is met when you deliver it. And they control the asset. $800,000 payment due in 30 days. Again, still the $800,000. You performed your obligation. You've earned it. And so you go ahead and record the $800,000 at the point of sale, even though they're not going to pay you later. We sell goods to Magnus for $500,000, payment due in 2 installments. The first installment is in 18 months. The second is due in 6 months later. The present value is $464. Okay. So anytime the payments are more than 1 year away, okay, FASB expects us to consider time value of money and interest. If it's less than a year, FASB says don't mess with it. It's not worth it. But when it's more than a year, FASB says, yeah, go ahead and record the interest in there. Now this is going to be interest revenue to us, right? Because we're kind of financing it for them by letting them pay 18 months out and 24 months out. You see that? 18 months out and 24 months out. So we've got to figure out the interest in there as well. Well, they went ahead and calculated it for us because that wasn't the point of this problem. We could calculate the present value based on interest rate. We can do that. And it came out to $464. Now they're going to get more than $464, aren't they? How much are they going to get? They're going to get $500,000 in 2 installments. So they're going to get more. So the difference in this and the $500,000 is what? It's going to be interest revenue to us, isn't it? We're going to have a discount account, and that's going to be interest revenue, and we will accrue that. We'll transfer that to interest revenue. So you want to record substance over form. Substance over form. And this is a good example of that. Questions on 2? All right, let's look at number 3 on page 1095. In September of 14, the Gardner Corp, man, that's spelled just like Michelle's last name, commenced to selling 150 of its iPhone-compatible docking stations to Better Buy for $15,100 per product. The stations are delivered to Better Buy over the next 6 months. After 90 stations are delivered, the contract is modified, underline modified, and Gardner promises to deliver an additional 45 products for $95 each. All sales are cash on delivery. This is exactly like the textbook went through. I mean, it's the same type of problem. Is this a new contract, or is it really with the old contract and we just have to modify it? All right. So the first question says, prepare the entries for the sale of the first 90 stations, $54. That's cake, right? Debit cash, credit sales revenue, cost of goods sold, and inventory. So they made a little over $4,000 on that gross profit, didn't they? Questions on A? All right, let's look at B. Prepare the journal entry for the sale of 10 more stations after the contract modification, assuming that the price of additional station reflect the standalone selling price. And that's huge. Circle standalone selling price at the time of contract modification. In addition, additional stations are distinct from the original product as Gardner sales. So what we're saying here is that this is a new contract. This is a new contract because it's standalone pricing, basically. Well, now you're saying, wait a minute, it was 100 and now it's 95? Well, this is later, and so the prices have come down some. And that happens a lot with this technology. It goes down pretty quick sometimes. So that's the standalone. So you can see the entries, we're still using the $100. We're still using the $100 for the next 10. So remember, the original agreement was for 100, and the second agreement was for 45 more. So we're going to finish out that 10. And you know what the next question is, right? The next statement is, it's a new contract. It's a new contract. All right. It gets a little more complicated when it's a modification. All right, the next one says, well, assume it's a modification. That it's not distinct, it's not a standalone, just assume that. So what we have to do is everything left from the old contract, we bring those 10 here, we're selling those at $100 a piece. We're bringing in 45 more at $95 a piece, so we have to have a blended price. So the next 10 we sell will have a blended price, right? And then the rest of them will have a blended price too. But even though those last 10 are from our original contract, it's a blended contract. So basically we have 60 more to deliver, all right, at $100. And then we've got 45 more, and the total remaining revenue, I misspoke about the 10, there's 60 more not yet delivered. So we got to take what's not delivered based on the 100, what will be delivered based on the new, and blend it together. So there's 105. There's 105 that'll be at $97.86. And of course, it's kind of nuts, really, because at the end, all the revenue is going to be the total, going to be the same. But if you happen to sell some of them here and some of them here, it would make a difference. If there's a year end in there, if some of them were sold here and some of them were sold here, if they were all sold here, the total revenue is going to be the same. But again, you got that year end in there. The numerator includes products not yet transferred under original contract, plus products to be transferred under contract modifications. So that's why we divide by 105. So it's really easy if it's a new contract, right? Distinct, standalone. When you got to modify it, you got to blend everything that's still remaining from the original plus all the new, get your new price. Questions on that? And there your journal entry. At $97.86. See how the blended works compared to the other? All right, exercise 4, another contract modification. We need to go, yeah, let's go ahead and do this one real quick. Anyway, this is for bookkeeping and tax reporting services. We usually get focused on products in here, so you can see the cost of goods sold and all that. But this one doesn't have inventory, so there's no cost of goods sold. We perform bookkeeping and tax reporting services for startup companies. January 1st, Tyler entered into a 3-year service contract with Walleye Tech, okay. Walleye promises to pay $10,000 at the beginning of each year. Now think about that. January 1st, you're going to get a $10,000 check, and which at contract inception is the standalone selling price for these services. At the end of the second year, the contract is modified, circle that, and the fee for the third year is reduced to $8,000. Now wait a minute. at the end of the second year, okay, at the end of the second year, so you got 10 and 10, then at the end of the second year, the third year is going to be reduced to 8. In addition, voila, agrees to pay an additional 20 at the beginning of the third year to cover the contract for 3 additional years. Wow, getting crazy. So, 4 years remain after the modification. So you got third, fourth, fifth, and sixth. Yeah. The extended contract services are similar to provided in the first 2 years. So it's a standalone deal. Well, let's just walk through these. I know it's confusing. So, at the beginning of January, a guy walks through that door, gives you a check, and says, here, do all my write-up work and everything, my tax services for the year. And you say, Shirley, see you later. You debit cash, credit unearned service revenue, and you know that's a liability. Right? So, during the year, you go and do all their work. And if you were going to prepare monthly financial statements, you would divide that by 12 and take a 12th out of that and send it to service revenue. We just did this at the end of the year just to make it easier. Just to take it out. During 14, we earned it all, so at the end of the year, we transfer it to revenue. All right, January 15, same thing. He walks through the door, says, here's 10 grand, debit cash, credit unearned service revenue, which you know is a liability. At the end of the year, you take it out of that liability and recognize it as service revenue. Questions on that? All right, then we start the modification journey. All right. On January 1, he walks through the door and says, hey, you know, you've done really well. I love you. I love your write-up service. I love your taxes. But, you know, what about if we commit to you for a longer period of time? Would you give us a break? And you think about it. Yeah, I'll give you a break. All right, I'll give you a break. All right, so basically we got 2 more years. We got $28,000 there, right? So he walks through the door and hands us 28 grand. Hands us 28 grand, basically. So basically that 20,000 is for 2 more years, and that 8's for another year, basically. And so you're saying, well, what's the deal here? But the point is, since we are modifying this contract, this is considered a modification, we take that 28,000 because it's going to cover this person for another 4 years. So let's look at that again. That modification was a little troubling there. While he agrees to pay an additional 20 at the beginning of the third year to cover the contract for 3 more years, at the end of the second year, the contract's modified and the fee for the third year is reduced to 8. Okay, so it's 8. I'm sorry. Excuse me. So 8 of that is for the third year, and then he gives us 20 for 3 more years. All right, you understood that. I did. So, but the point is, we have to divvy this out over the next 4 years equally. The modification of the contract does not result in a new performance obligation. As a result, the remaining service revenue is recognized evenly over the remaining 4 years. If it was not a modification, what we would do, we would recognize it exactly as it says in here. We wouldn't bring it all together and average it out. Okay? We would take the original 20 and divide it by 3 and recognize that, and then just exactly like it says. Given the change in service extended contract period, the services are distinct, the modification should not be considered part of the original contract. So if that's the case, Tyler recognizes revenue on the remaining service at different rates. Tyler will recognize $6,667, as I mentioned, 20,000 divided by 3, and then the extended period will be taken care of as well. So here's where we debit cash and credit unearned service revenue for the 28, and just like we did before. But we're going to pull it out at different amounts. All right. So at the end of 16, we'll pull out 8,000. They didn't give you all those entries, but I think it makes sense to you. You'll pull them out exactly as they were stated. You would not have to take a blended approach. That means you would consider each one of them a different performance obligation. So that one's a little crusty. All right, variable consideration. let's review this number 5, page 1048, before we jump into that. On page 1048, it talks about determining the transaction price. And usually that's not hard. Usually it just says it just like we just talked about. Here it is, and then you got to figure out if it's modified or unmodified. Well, there are things that can be thrown at you, like variable consideration. You got rebates and discounts and credits and performance that you as a supplier, if you're a business that supplies to Target or Walmart, you might give them discounts for volume. You might give them rebates when they advertise your product in their advertising. So those are variable considerations, because what it do, you net it out. You were charging them 10, now you're going to charge them 9,500 because they're advertising your product and those kind of things. So you have to take that into consideration. And then estimating variable consideration, you can do a sensitivity analysis like they do on 1049. They got 60, 30, and 10% chance. And you got to consider the time value of money in your price, like the one we already looked at, right? We already looked at one of those. We got to look at the time value if it's more than a year. We have to take that into consideration. And then, of course, any non-cash consideration must be fair market value. The problem will have to tell you or give you a hint about the fair market value. So that goes number 3. You've got to determine the price, and sometimes it's not as easy as it looks. It usually isn't terrible though, but it can be troublesome. So number 5, variable consideration on page 1095. Blair Biotech enters into a license agreement with Payne Pharmaceutical for a drug under development. Blair will receive a payment of 10 million big ones if the drug receives regulatory approval. Based on prior experience in the drug approval process, Blair determines it's 90% likely the drug will gain approval and 10% if denied. So they got a lot of experience. They're a drug company. They probably got people on the inside in the FDA, Food and Drug Administration, that's doing the research and testing on it. Maybe they're giving them some hints. Anyway, determine the transaction price of the arrangement for Blair. The arrangement only has 2 possible outcomes. If regulatory approval is achieved or not. If it's not achieved, nothing. You go back to the drawing board, do more research, and then take it back. Blair determines transaction price based on the most likely approach. So we're going to use the most likely approach, and we're not going to take a weighted average here. And so we're just going to go ahead and book that. So at the end of the year, if this is the end of our fiscal year, we're going to debit accounts receivable and credit license revenue. And then if it gets approved, cash and accounts receivable. So the reason we had to do this is like everything else in here, right? We had a year end that came in, and we basically made this contract. We've got a contract with these folks. What's our performance obligation? Well, it's not really our obligation. The FDA has to approve it. But if they approve it, our performance obligation is complete, right? Even though we can't do anything about it, unless we try to bribe them or something. We shouldn't do that, obviously. But if it comes through, then, and we think it will come through, then we get the cash and accounts receivable. But the point is, there was a year end in here, so we had to decide. We had to decide to recognize it or not recognize it. And they had some history in this type of thing. Obviously, they're a drug company, and they do this stuff all the time. So the most likely approach. They could have taken a percentage. They could have said, okay, 90% times a million, 10% times a million. Well, it'd come out to the same. That'd still be $1 million. So that wouldn't work. Well, all right, let's look at trailing commission let's look at the trailing commission. So what's happened here is you're going to be selling insurance. Look at that problem. You're selling insurance, right? You get $100, if I recall correctly, every time you sell an insurance policy. And then for every year they don't cancel that insurance policy, you get an extra $10. And that's not uncommon. A lot of people pay the first premium, and then they go, I can't afford this, or man, that insurance guy sure was slick, but this is not good for me. And they just don't pay the premium, and it expires, of course. So you want to sell to people who are going to keep paying. Because if an insurance guy or gal is just really just putting pressure on people to buy, they might, again, pay the first premium and then they're done. But anyway, so you're the insurance company. So we sell the policy. Our performance obligation is met because we sold the property. I mean, the insurance, sold the insurance. So our performance obligation is met. And so basically we have to determine how much to recognize. Now, every time they send in, insurance policies have monthly and yearly premiums, right? Sometimes it's monthly, sometimes it's yearly. So you would think, okay, well, after you sell the policy, is there anything else you can do? Your performance obligation is met. If they keep paying the policy, that's great. But your performance obligation is met when you sell the policy. So we have to decide how many of those $10 we're going to get. And it tells you that they believe that 4.5 years? There's 4.5 years there based on their history, and it's based on their history. They have experience that they can do this. If this company had no history in it, they couldn't do this. They couldn't estimate how many. Then they just have to recognize them as they came in if they didn't have any experience. So you can see how it's done. Aaron determines the transaction price for 100 policies is 100 times 100. And then we think we'll get $10 for 4.5 for 100 of them. So we debit cash for the full amount because we sold them. We debit accounts receivable for the future payments, and we credit service revenue for $14.5. So we believe of these 100 policies, 4.5 would be $10, so that's our accounts receivable we're going to be getting. But the point is, all of that service revenue is going to go in that 1 year because our performance obligation is met. I know I'm beating that to death, but when it comes to test time, somehow it hadn't gotten through. Because on average, customers renew for 4.5 years, Aaron includes that amount in the estimates for transaction price. When Aaron satisfies his performance obligation by selling the policy, it recognizes $145 on each policy. It's reasonably assured. It's reasonably assured. Well, what happens if they don't pay? Then when they do drop out, some of these folks, well, it'll become a bad debt expense because you got an accounts receivable. You'll write it off against your bad debt expense you accrue every year. Let's skip 7. I got an X there. I don't remember why I put an X there, but I put an X there. Number 8, sales with discounts. This is a good one, sales with discounts. Everybody loves a discount, everybody loves a bargain, right? Taylor Marina has 300 available slips, so picture a marina, all kinds of boats, and you got the little slips. That rent for $800 per season. Payments must be made in full at the start of the season, April 1st. The boating season ends October 31st, and we've got a 12/31 year end. Now this gets kind of complicated. Slips for future seasons may be reserved if paid for by December 31st, 2015. Under a new policy, if payment for 2016 season slips is made by December 31st, 15, you get a 5% discount. And then it also says if payment for 2017 season slips is made by December 31st, renters get a big 20% discount. So they need some cash to repair the docks. On December 31st, 14, all 300 slips for 2015 were rented. So wow, that's great. You got your money there. On December 31st, 15, 200 slips were reserved and paid for the 16 boating season, and 60 slips were reserved and paid for 2017. So we're doing all this at the end of 15, I guess. At the end of 15. So we're at the end of 15, and we got deals for 16 and 17. We got deals for 16 and 17. So let's look at the entry. Since this is a service, we don't have cost of goods sold to mess with, right? So basically, what we're going to do, all of them we're going to rent it out, 2015, 300 times 800. Now, was there a discount on that? Wasn't a discount on that because this was the end of this was at the end of this was the end of 14 for 15. So at the end of 14, and remember the season starts on April 1st and goes to October, I believe. So no discount because everybody wants it. You don't have to give a discount with that kind of demand, right? You don't have to give a discount. You get the whole thing. So now they didn't ask us to make the entry for 2014, but at the end of our season, what would we do? We would take it out of that liability account and recognize it as revenue, wouldn't we? At the end after we've earned it. After our performance obligation. So our performance obligation is just sitting there, letting people rent their slips, taking care of the boats. So after your performance obligation is met, you would take it out of there and transfer it to rent revenue after time passes. Okay, it's the end of the year, end of 15, you're looking forward to 16. Two people said, yeah, I'll pay you $800, but I want a 5% discount, so I'm not going to give you quite $800. I'm going to take advantage of that for 2016. So they gave him a 5% discount. But again, this is not revenue, is it? This is an asset, this is a liability. It's not revenue. At that time, we also said, you know, we need some money to repair our docks. So, we will give everybody a 20% discount if you go ahead and reserve for the next year too. So you just debit cash and take out the discount and book your entry. Then at the end of 2017, which is way down the road, of course, you'll take that out and recognize as rent revenue after your performance obligation. Have we met any performance obligations right here? You haven't earned it. We used to call it always earning. You haven't earned it. We haven't met your performance obligation. Same thing. I'll let you read through B on your own. Let's look at, let's see. Yeah, let's allocate a little bit. So you can see the objectives on the side there. We've been spending a lot of time on 5, and this is jumping to 6, allocating the transaction price, okay? So we've determined the transaction price, and now we're going to allocate the transaction price. You only have to do this if you have more than one performance obligation, right? Only if you have more than one performance obligation, you have to do that. So Shaw Company sells goods that cost $300,000 to Ricard Company for $410 on January 2nd, 14. The sales price includes installation, which is valued at $40,000. The fair value of the goods is $370. The installation is considered a separate performance obligation, is expected to take 6 months to complete. So here's the key, right in front of you. The total revenue of $1 million should be allocated to the 2 performance obligations based on their relative standalone selling prices, using relative fair value. In this case, the fair value should be considered $1 million, and the fair value of the installation fee is $50. The total fair value is $1,050,000. So you do this a lot in accounting, especially in cost accounting. You allocate one number based on other numbers. It has to be some kind of cause and relationship, of course. So we're going to take our $1,050,000, divided by 1,000,000, divided by 50 to get our percentages. And so our equipment is going to get 1,000,000 divided by 1,050,000, which gives you some percentage in the 90%, times 1,000,000, which gives you 95.2%, right? So 1,000,000 divided by 1,050,000 would give you about 95.23%, 0.24%, and that's going to be the amount that goes to the equipment. Okay, so that's going to be our sales for equipment. And then the installation gets the other 50, 40. Of course, you really wouldn't even have to do this, but it's good to go. It's good to know how you got that. The rest of it would go to that. So here are our entries. We debited cash, $1 million, sorry about that. Is yours down here on that copy? Did yours get messed up? Yeah, yours got messed up too. Sorry about that. Well, this is the way it should look. Oh, well, that 47,619 should be there, and the 952, 381 should be there, of course. You know that. Okay, so, well, now wait a minute. We went in and recognized sales revenue for the equipment? Yeah, because you finished it before you're finished. It's done. All right? You've sold it basically on June 1st. Because all this has to be recorded on June 1st. So you got June 1st there that this is allocated to. And so, of course, that should be a credit, and that should be a credit. And then your cost of goods sold should do that as well. Out of inventory, out of cost of goods sold. And then at the end of your service period, or if you did it every month, you would divide by 12 and do it each month. But your earned service revenue is going to be debited. That's a liability. You debit to reduce it and transfer it to service revenue. The sale of the equipment should be considered upon delivery as the customer controls the assets. Control is a big word now, because your performance obligation has been met. Your customer controls it. You no longer have control over it. You cannot direct it in any way. So it is theirs. Service revenue for the installation is recognized on September 30th. The service has been provided. The performance obligation is satisfied. So that's not too confusing. Let's do look at 12. I think number 12 is a little more. We're going to do basically the same thing. All right. We're using the same information, but we're saying crankshaft does not have market data with which to determine the standalone selling prices of the installation service. You got that? They don't have the fair value, so they make it a little more complicated. As a result, an expected cost plus margin approach is used. The cost of installation is 36, and usually we mark up these kind of services 25%. So we don't have a fair value like we did for the 50 grand. You see what they're doing? So they're using the same information, changing it slightly. So the total revenue of $1 million should be allocated to the two performance obligations based on their relative fair values. The fair value of the equipment is considered, the fair value of the installation fee. But we don't really have the fair value, so we use the cost plus approach. We know it's going to cost us 36. 25% times 36 is going to be added to give us 45. You see where the 45 comes from. So it's the same exact thing as the last one, except instead of being $1,050,000 and it's $1,045,000, and this is only 45. So it changes the percentages slightly, not terribly, but it does change the percentages. But it's the exact same thing. I didn't mess this one up. You got your cash, your service revenue, your sales revenue, inventory to cost of goods sold. Now here you'll notice also there is another difference. They went ahead and recognized these on September 3rd. Well, September 30th is when they complete the installation. Yeah, the installation. I would encourage you to look at 13 too. That's a great one. You got oven, installation, maintenance, and they show you the relative fair value. So that's a great one to study. Let's say 4. That's the last one on there. No, let's go ahead and look at 4. It covers one more objective that we hadn't really covered. That's pretty easy. If you look at problem 4 on page 1103, So page 1103, problem 4. Allocate transaction price, discounts, and time value. So notice the objectives are 4, 5, 6, and 7. This is 4, 5, 6, and 7. The Economy Appliance Company manufactures low price, no frills appliances that are in great demand. That's a good thing. Pricing and cost information. You got your items: refrigerator, range, stackable washer, dryer, your standard selling price, cost, selling price, and the cost is in parentheses. So $260 cost, we sell it for $500. Customers can contract to purchase either individually at the stated prices or in a bundle with a price of $1,800. So picture that. All right, I can get these for $1,800 instead of a little bit more than $1,800. A little bit more basically. The bundle price includes delivery and installation. Economy provides delivery and installation on a standalone basis for any product for $100. So we have the standalone basis and we have our cost. All right, let's look at A. On June 1st, Economy sold 100 washer dryer units. Remember, they're stackable, they're together. You've seen those before, one unit. Without installation to Lamp, where do they come up with these names? Lamp Rentals for $70 grand. Lamp is a newer customer and is unsure how this product will work in its older rental units. The Economy offers a 60-day return privilege and estimates, based on prior experience with sales of this product, 4% of the units will come back. Prepare the entries for the sale and related cost of goods sold. Okay. Now, when we really hadn't talked about this too much in intermediate accounting, allowing for returns. We talk about allowance for bad debts, and then when it comes, if somebody doesn't pay, you debit the allowance and credit the accounts receivable. But we really hadn't messed with estimating returns. So if you have prior experience and you have a good working knowledge of the industry, when you can book your sale as long as you can estimate how much will be brought back. And then you have to book the entries as you see in front of you. Okay, so here's A. We're going to debit accounts receivable for the $70,000, but based on our history, we've got a refund liability of $2,800, so we're only going to book the sales revenue for $67,200. This is a new account, isn't it? You've never seen that account before, refund liability. But it's pretty straightforward. That's exactly what it is. So when they actually bring them back, we'll debit that account and credit the accounts receivable. See, we don't know who's not going to bring these back, right? We don't know which ones are going to come back, but we know some of them will probably not make it. So we debit cost of goods sold for the $38,400. We estimate our inventory returns 4% of $40,000, which is our cost of goods sold, and we credit inventory. So it's got to come out of inventory cost, but only $38,400 is going to cost of goods sold because that's going to be estimated inventory returns, $1,600. So those are a couple of new creatures. But the point is, if you've got the history and the knowledge, you can do this. You can book that sale, but you don't book the revenue for the amount that they're not going to be brought back, you think. Let's look at one more before we go. Yellow Card Property Manager operates upscale student apartment buildings, just like here at Eureka, upscale student apartment building. Ha-ha. On May 1st, 2014, Economy signs a contract with Yellow Card. You're the accountant. You're the accountant for Economy. Economy signs a contract with Yellow Card for 300 appliance bundles to be delivered and installed in one of its new buildings. Yellow Card pays 20% cash at contract signing and will pay the balance upon delivery and installation no later. Prepare journal entries when all appliances are delivered and installed. So you can see by the entries, all you have to do here got a 20% discount. signing the contract. So basically, all you gotta do is net out the discount and book it. No problem. Have any of y'all ever been in those new Vanderbilt dorms? Right there? I wonder what, I haven't either. I just wonder what they're like. Have you seen them there, the new ones, as you go out West End, sitting up there on the left? They are huge, and I'm sure they're beautiful. Not as nice as ours, but anyway. You got cash under sales, you got that 20% discount. And then, of course, when you deliver them, they're going to pay you the rest of them. So on this first one, they're paying you 20% down to lock the price in. They're kind of hedging, right? They're kind of hedging, but that's not what we're calling this. They go ahead and lock in their price by giving us 20% down. Everybody see that? And then when we have the performance obligation, they give us the rest of it. When we deliver them, we got the sales revenue of $300 for $1,800 cash, and then our sales revenue for $108, and then the cost of goods sold. So make sure you read through that. We'll leave the other two for Monday. Again, no homework, but I'm telling you, you need to be studying this stuff. Study it hard.
The test is scheduled for like not this next Wednesday, but the next one. Is that when it's going to be?
It's going to be. I think it's going to be the next Monday. Is that okay?
Instead of the 27th, it'll be the 25th.
Yeah, if we can. Is that troublesome to anybody? I mean, is that in the way of anything? Because unless we can't get discovered, I think we can get all covered pretty good.
When will QuickBooks be?
That Friday.
Friday.
And I'll send out.
So what will be the Wednesday then? Nothing?
Party time, right? Because we don't have that Monday's not, that Monday starts finals, right? That next Monday.
Yeah.
So we don't have an extra day.
Will you send a study guide for the finals?
Yeah. And I sent out a study guide for the QuickBooks.
Okay, so
This morning.
test is moved to the 25th until.
Well, does the syllabus say the 27th?
Yeah.
Oh, well, we'll stay with 27th. That's fine with me.